Introducing a beginner's manual on technical analysis, a comprehensive video series tailored specifically for those who are new to the world of trading. Whether you're just starting out or looking to deepen your understanding, this series is your roadmap to success. Throughout this series, we'll cover everything you need to know to get started with technical analysis. From understanding chart patterns to deciphering key indicators, each episode will equip you with the knowledge and skills necessary to make informed trading decisions. So, if you're ready to take the first step towards becoming a confident and successful trader, be sure to subscribe to our channel and hit that notification bell so you never miss an episode. Together, let's unlock the secrets of technical analysis and pave the way for your trading journey. Let's dive in. Hey traders, and welcome back to Risk with Purpose, your ultimate destination for learning to trade with confidence and precision. I'm Technical Tiffany, and in this video, we will explore 3 popular oscillators used by traders and investors for analyzing market momentum and identifying potential trend reversals: the Relative Strength Index, Stochastic Oscillator, and Moving Average Convergence Divergence. Let's get started. Lesson 2. Oscillators, Relative Strength Index, Stochastic Oscillator, and MACD. Welcome to Lesson 2 of Section 3, Technical Indicators. In this lesson, we will explore 3 popular oscillators used by traders and investors for analyzing market momentum and identifying potential trend reversals: the Relative Strength Index, or RSI, Stochastic Oscillator, and Moving Average Convergence Divergence, MACD. Relative Strength Index, RSI. The Relative Strength Index is a momentum oscillator primarily used in stock trading that measures the speed and change of price movements, indicating whether an asset is overbought or oversold. The RSI is calculated based on the ratio of upward price changes to downward price changes over a specified period, typically 14 days, although this period can be adjusted according to the trader's preference. Calculation. The RSI is calculated using the following formula. The RSI value ranges from 0 to 100. Traditionally, RSI values above 70 are considered overbought, suggesting that the asset may be due for a price correction or reversal downward. Conversely, RSI values below 30 are considered oversold, indicating that the asset may be due for a price increase or reversal upward. However, traders may adjust these levels based on market conditions and the asset being analyzed. Overbought condition. When the RSI is above 70, it suggests that the asset may be overbought, meaning that it has experienced significant buying pressure and may be due for a pullback or reversal. Oversold condition. When the RSI is below 30, it suggests that the asset may be oversold, meaning that it has experienced significant selling pressure and may be due for a bounce or reversal. Divergence. Divergence occurs when the price of the asset and the RSI move in opposite directions. Bullish divergence occurs when the price makes a new low, but the RSI does not, suggesting a potential reversal to the upside. Conversely, bearish divergence occurs when the price makes a new high, but the RSI does not, suggesting a potential reversal to the downside. Failure swings. Failure swings, also known as bullish/bearish failures, occur when the RSI reaches overbought or oversold levels, retreats, and then fails to reach the previous high or low. This can signal a weakening trend and potential reversal. I like to set my RSI signals at 80 overbought and 30 oversold. I do this to filter out some of the short-term noise, as equities markets can stay overbought for quite some time. Traders often use the RSI to identify potential entry and exit points in the market. For example, when the RSI indicates that an asset is overbought, traders may consider selling or shorting the asset. Conversely, when the RSI indicates that an asset is oversold, traders may consider buying or longing the asset. It's important to note that while the RSI can be a useful tool for identifying potential trends and reversals, it is not foolproof and should be used in conjunction with other technical and fundamental analysis tools to make informed trading decisions. Additionally, traders should be aware that during strong trending markets, the RSI may remain in overbought or oversold territory for extended periods of time. So it's essential to consider the overall market context when interpreting RSI signals. Stochastic oscillator. The stochastic oscillator is a momentum oscillator in technical analysis designed to assess the strength and direction of price movements in financial markets. It calculates the relative position of a security's closing price within its price range over a specified period, typically 14 periods. This oscillator comprises two main lines, the %K line and the %D line. The %K line represents the current closing price's position relative to the highest high and lowest low over the specified period, while the %D line is a moving average of the %K line, usually over 3 periods, to smooth out fluctuations. With readings oscillating between 0 and 100, levels above 80 indicate overbought conditions, signaling a potential price correction or reversal downward, whereas levels below 20 suggest oversold conditions, indicating a potential price increase or reversal upward. Calculation. The stochastic oscillator is calculated using the following formula. In this case, the current close is the most recent closing price. The lowest low is the lowest price the asset reached within the specified time period. The highest high over the specified period is the highest high of the asset's price within that period. Once the %K value is calculated, traders often smooth it using a moving average to generate the %D line, known as the signal line. The most common smoothing period is 3. So, the stochastic oscillator typically has two lines, the %K line and the %D line. How to interpret the stochastic oscillator? The stochastic oscillator oscillates between 0 and 100 and is typically depicted as two lines on a chart. Traders use the following interpretations. Overbought condition. When the stochastic oscillator rises above 80, it indicates that the asset may be overbought, suggesting that the price may be due for a pullback or reversal. Oversold condition. When the stochastic oscillator falls below 20, it indicates that the asset may be oversold, suggesting that the price may be due for a bounce or a reversal to the upside. Crossovers. When the %K line crosses above the %D line, it generates a bullish signal, suggesting potential upward momentum. Conversely, when the %K line crosses below the %D line, it generates a bearish signal, suggesting potential downward momentum. Convergence. Convergence occurs when the price action of the asset and the stochastic oscillator move in the same direction. This suggests that the current trend is likely to continue. For example, if the price of the asset is making higher highs and the stochastic oscillator is also making higher highs, it indicates that the bullish momentum is strengthening. This alignment confirms the uptrend. Bullish divergence occurs when the price of the asset makes lower lows while the oscillator makes higher lows. In other words, the momentum indicator, oscillator, shows strengthening momentum in the upward direction, even though the price is moving downwards. Bullish divergence suggests that while the price may be weakening, the underlying momentum is indicating a potential upward reversal. Bearish divergence occurs when the price of the asset makes higher highs while the oscillator makes lower highs. This situation implies that the momentum indicator is showing weakening momentum in the upward direction, despite the price continuing to rise. Bearish divergence suggests that although the price is increasing, the underlying momentum is indicating a potential downward reversal. The stochastic oscillator can be applied to different time frames, from intraday to long-term charts, depending on the trader's preferences and trading style. Traders often use the stochastic oscillator in conjunction with other technical indicators and analysis techniques to confirm signals and assess overall market conditions. Like any technical indicator, the stochastic oscillator can generate false signals, especially in ranging or choppy markets. Traders should use it in conjunction with other tools and exercise proper risk management. Moving Average Convergence Divergence, MACD. Moving Average Convergence Divergence, also called the MACD, is a trend-following momentum indicator that shows the relationship between two moving averages of an asset's price. MACD consists of two lines: the MACD line, the difference between the 12-period and 26-period EMAs, and the signal line, a 9-period EMA of the MACD line. Bullish signals occur when the MACD line crosses above the signal line, indicating upward momentum, while bearish signals occur when the MACD line crosses below the signal line, indicating downward momentum. The signal line is a 9-period EMA of the MACD line. It helps smooth out the MACD line and generates trading signals. Calculation. The 12-period EMA is calculated by taking the average closing prices of the last 12 periods, giving more weight to recent prices. This EMA represents short-term price momentum. Similarly, the 26-period EMA is calculated by taking the average closing prices of the last 26 periods, also giving more weight to recent prices. This EMA represents longer-term price momentum. MACD line. The MACD line is obtained by subtracting the 26-period EMA from the 12-period EMA. The formula is MACD line equals 12-period EMA minus 26-period EMA. There is also a component of the MACD called the histogram. The histogram's bars show the distance between the MACD line and the signal line. A rising histogram indicates increasing momentum, while a falling histogram suggests decreasing momentum. The histogram is plotted as bars above or below a central zero line, with positive values indicating that the MACD line is above the signal line, and negative values indicating that the MACD line is below the signal line. Traders use the MACD histogram to gauge the strength and direction of momentum in the market. When the histogram bars are positive, it suggests that bullish momentum is increasing, as the MACD line is rising above the signal line. Conversely, when the histogram bars are negative, it indicates that bearish momentum is increasing, as the MACD line is falling below the signal line. In addition to showing momentum, traders also pay attention to the width and height of the histogram bars. A widening histogram suggests increasing momentum, while a narrowing histogram suggests decreasing momentum. The height of the bars relative to the zero line indicates the strength of the momentum. Large positive bars indicate strong bullish momentum, while large negative bars indicate strong bearish momentum. Interpreting MACD signals. MACD crossovers. Bullish signals occur when the MACD line crosses above the signal line, indicating increasing bullish momentum. Conversely, bearish signals occur when the MACD line crosses below the signal line, suggesting increasing bearish momentum. Divergence. Divergence occurs when the price action and MACD histogram move in opposite directions, signaling potential trend reversals. Bullish divergence occurs when the price makes lower lows, but the MACD histogram makes higher lows, indicating weakening bearish momentum and potential upward reversal. Conversely, bearish divergence occurs when the price makes higher highs, but the MACD histogram makes lower highs, suggesting weakening bullish momentum and potential downward reversal. Trend identification. Traders use MACD crossovers and histogram analysis to identify the direction and strength of the trend. A rising MACD line and positive histogram values indicate bullish momentum, while a declining MACD line and negative histogram values indicate bearish momentum. Signal confirmation. MACD signals are often confirmed using other technical indicators or analysis techniques, such as support and resistance levels, trend lines, or volume indicators, to increase the reliability of trading decisions. Risk management. Traders employ risk management techniques, such as setting stop-loss orders and position sizing, to manage potential losses and protect capital while trading with MACD signals. Traders utilize oscillators like the RSI, Stochastic oscillator, and MACD to pinpoint instances of overbought and oversold conditions, potential shifts in market trends, and discrepancies between price movements and momentum. These tools, when combined with other technical analysis instruments, serve to validate trading signals and enhance decision-making processes. The Relative Strength Index, Stochastic Oscillator, and Moving Average Convergence Divergence MACD, are pivotal in assisting traders and investors in assessing market momentum and uncovering promising trading prospects. By grasping the methodologies behind these indicators and their interpretations, you gain valuable insights into market dynamics, empowering you to execute trades with greater confidence and precision. And that's it. Thank you for joining us on this journey into the world of oscillators. We hope you gained valuable knowledge and strategies to enhance your trading skills. If you found this video helpful, don't forget to smash that like button and subscribe to our channel for more in-depth discussions on financial markets and trading tools. Remember, success in trading comes from continuous learning and disciplined execution. Stay tuned for our next video, and until then, may your trades be profitable. Happy trading!